suggested what they could go to 31, or that's the initial offer, and the best and final could be beyond that.
So what a Paramount banker had suggested to one of Warner Brothers' board members was that they would pay at least $31 a share if Warner Brothers were to engage. We don't know how much higher they'll go than that.
All right, Michelle. I can't recommend to everybody enough to follow Michelle's reporting, because you have been an absolute beast on breaking these stories. That's Bloomberg's Michelle Davis. And Michelle, I promise you will be joining me tomorrow on Bloomberg Deals. That's at noon on Wall Street time. So tune in to that to get all of Michelle's exclusive reporting. Coming up, General Mills warns of a sales slowdown despite lowering prices. That's coming up next. You're watching Bloomberg TV.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Open Interest.
How are your discussions with President Trump?
The administration's been great to work with. Ford is the most American car company. We produce the most hourly workers. We've made progress on mitigating some of the tariffs, but we have more work to do.
How do you make sure that you're winning straight out of the gate?
Give us a few sleepless nights. We feel we have the right people, the right tools, the right spirit across what Red Bull means and what Ford means.
Don't miss Open Interest live every weekday.
Up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
You are watching Open Interest. I'm Danny Berger. Let's get a check on stocks this morning. About 20 minutes into your trading day, and we are now trading at the lows of the morning. Okay, only in 20 minutes, but this wall is decidedly matching me this morning, or I'm decidedly matching it. I apologize if I have any influence over this equity market action. The NASDAQ, it's now down almost 1%, 0.9% to be specific. The S&P falls 0.5%. It's a week last week where we fell more than 1%. It's been a struggle to hold on to any gains. A lot of chop underneath the surface, and you're not seeing that broadening out. The Russell 2000 also having a poor day, down 0.6%. The Dow is under 50K. Someone let Pam Bondi know. She'll be alarmed to hear that. Bloomberg Dollar Spot, that gains, even though the latest Bank of America Fund Manager survey had one of the most bearish readings in quite some time on how investors feel about the dollar. Brent crude, that's down 1.7%. It had been rallying with the talks in Geneva happening between Iran and the U.S. and threats of partial closings of the Strait of Hormuz. NVIDIA, that's part of the reason that we are seeing some serious declines in both the NASDAQ and the S&P, down more than 1%. Apple, though, that's rallying after getting beat up. Dan Ives out with a note this morning saying that Apple's going to benefit from AI. People have been punishing it as if it was not participating. We're just talking to Michelle Davis about the latest twists and turns in Paramount, Skydance, and Netflix. It's the deal that refuses to go away. So Paramount has sweetened its bid for Warner Brothers, and they've reopened negotiations. Netflix has granted them a 7-day waiver for them to give their best and final offers. One of the bankers suggesting to the board of Warner Brothers that the first and at least initial bid could be at $31. They're currently at $30. And then we have the consumer giants. General Mills down 7%. Lower sales outlook. Cereal, snacks, dog food, all seeing the biggest hits. Let's bring in Bloomberg consumer editor Emily Cohn to discuss. Emily, they lowered prices, so what went wrong here?
So I think what we're seeing now is consumers are trading down. Think about the brands that are General Mills, Cheerios, other snack foods where there are private label options that are cheaper. I think the same can be said about pet food. People are trading down to cheaper options right now. And either these are the kinds of foods that you just don't need in your pantry. They're more disposable. They're not the staples. Or that there are cheaper options at the grocery store.
Even for pets? I feel like that's got to be a signal because people love spending money on their pets and like buying the finest delicacies that their, tiny little Bichon Frise could eat.
You're so right. And I think in the pandemic, we saw a rapid rise in pet ownership. When people have more disposable income, they're likely to splurge on their pets. But that's where we're seeing people cut back now. We're seeing people cut back on the things that they don't need. Obviously, hopefully they're still feeding their pets, but they're not splurging on the brand names. There are private label options, there are cheaper options, and that's where General Mills is struggling.
So what does a General Mills do? I mean, do they keep cutting prices? Because we've seen, for example, I know it's different, it's not groceries, but McDonald's slashed their prices pretty aggressively, and then that led to a really good earnings season. Is that the tactic going forward? Keep prices as low as you can?
It's interesting, and we'll see more this week. I'm curious to hear what Walmart has to say about prices. A lot of companies have been eating the cost of tariffs for a year now, and there might not be much room for them to keep taking on higher costs and lowering prices. So, a lot of some companies in the consumer space are raising prices. So we'll see how long they can do. General Mills did say in the categories where they did cut prices, they saw volume up. But obviously, that's not enough to keep their bottom line growing.
Yeah, I guess we'll get Walmart on Thursday, right? So
Thursday morning.
See you
back here.
Bright and early Thursday morning. Also, will be interesting to see whether this is bad news for General Mills, is good news for Walmart, to your point, with some more bargains there.
Emily,
thank you so much for joining us. Always
Danny.
great to see you. That's Bloomberg's Emily Cohn with Walmart, now a $1 trillion company, even though there are concerns about the consumer. Coming up in the next hour, Sitara Sundar talks about the AI market jitters. Then we're going to talk about private debt and leveraged tech loans with Benefit Street's CEO. And Dave Dace of Goldman Sachs is going to discuss the firm's push into sports investments and the greater landscape for that. All of that coming up in your second hour of Bloomberg Open Interest.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger. Matt Miller on a well-deserved break this week as equity markets sink on the lows of the morning, down nearly 0.8 for the S&P 500. Coming up over the next hour, investors shun software stocks on AI fears. Fund managers warn that the worst may not be over. Anthropic and the Pentagon hit a snag in contract talks over mass surveillance and security concerns. Plus, oil swings as signs emerge that the U.S. and Iran are making progress on nuclear talks. We begin with AI worries on Wall Street fueling a software sell-off. Sitara Sundar, head of alternative investment strategy at J.P. Morgan Private Bank, sees a potential $6 trillion opportunity by the end of the decade. Writing, we are in the early stages of a shift from software as a service to services as software, where traditional labor-intensive business services evolve to being delivered through AI-powered software platforms. And Sitara joins us now. I love that you're finding the silver lining of everyone else freaking out. So many things have been selling off. So what is the opportunity? How do you sort of see software shifting among AI?
Yeah, I think that first, thank you so much for having me. It's lovely to be here. I think that what we're finally seeing in the market is this trend that we've been talking about really for well over a year now, which is a different definition of SaaS, and shifting from this idea of everything needing to be done from software as a service, subscriptions, recurring revenues, and things along those lines, to this idea that the disruption that we're going to see is going to broaden beyond just the tech sector. And it's going to disrupt what we're seeing as legacy labor-intensive services sectors. So we're finally seeing and come to fruition this idea that the ROI in artificial intelligence is disruption. So what does that mean? It means three things. It means agentic AI, so thinking about having a co-pilot next to you and a digital co-pilot. It means AI-enabled horizontal software, so think about your normal CRMs, but adding an additional AI layer on top of that. And it means vertical AI tools. So think industry-specific, legal, financial services, healthcare, all of those areas that have had information systems that have been built in the dark ages, like 20, 30 years ago, that are going to become digitized.
Do the incumbent software companies succeed in that environment, or do they get replaced?
I think that it's going to be a mix of both. Like, honestly, if I think about what's happening in the public markets right now, I think it's a short-term overreaction, but long-term right. So what does that mean? I think that there are a few factors that we're thinking about in the software companies that are going to be safer. For example, are you thinking about whether or not your process is truly embedded and ingrained in the overall end-to-end system? How deep are your partnerships? Are you really providing proprietary insight, or are you just gathering information? And the final thing I would note on this is your recurring revenue model seat-based or is it usage-based? Because if it's usage-based, you're likely going to be safer because productivity increases will lead to more usage, which will lead to higher revenue. Whereas if you're seat-based, if more and more areas of services end up getting automated, that actually might reduce the amount of revenues that you have because the number of subscriptions actually will end up going down. So when we think about the future, when we're looking about those durable business models, they need to have deep partnerships. They need to usually be a usage-based model. And the final point is that the models that are the information that you're actually going to be providing and needing, what level of accuracy and trust is needed within that? Because I think the other thing that maybe the market is missing at this point in time right now is whether or not the adoption of artificial intelligence is going to be more akin to the iPhone, where it was used as a productivity enhancer for human beings and therefore was adopted immediately, or is it going to be more like the adoption pace of gene editing and autonomous vehicles, where you need 100% accuracy, you don't want to be editing your genome improperly, or who is accountable at the end of the day? Who is accountable to the decision that agent ends up making? So the ultimate thing for investors is that the entire proliferation of artificial intelligence, all that we've seen in AI fueling this market for the past 3 years, the ROI stage is here. And what that means is that there's some legacy players that are going to be disrupted, but at the same time, to that silver lining point, there's going to be meaningful opportunity. And for me, sitting with my alt hat on, a lot of that innovation is taking place within private markets.
Can we just go back to that iPhone metaphor? Because
yes.
I love that. I think that is so incredibly well put. But what are you seeing among companies now? Because there does feel this real push that you need to stay relevant. You need to be investing in AI. So are they just doing it, adding an iPhone in all of their employees' pockets? Or are they being thoughtful about it? And are they really making real returns and being careful and being selective? Which part of the stage does it seem like we're in right now?
I think we're somewhere in the middle. I think there are going to be companies, and we've seen it, that are attaching artificial intelligence to an archaic system in which AI is actually not going to be able to make it more productive. But on the flip side, I think academic research is a little bit mixed on it, but we are actually starting to see tangible improvements from a productivity perspective and a EBITDA growth perspective and a margin perspective in a handful of areas that are actually reworking the end-to-end workflow and thinking about things from an AI native perspective and not just using their legacy system and trying to put artificial intelligence on top of it. And I think that bifurcation and that delineation will start to prove itself out in public market pricing soon.
Well, one of the things that I really struggle with are some of these sectors, just take commercial real estate, which had a very bad week because the idea being more AI, less workers, less need for office space, so commercial real estate doesn't do well. Presumably, if we get to that point, there are going to be bigger worries than like how commercial real estate is faring. It feels like the end point to when we discover whether or not these things actually come true. Like, we're talking really big societal changes. So how much conviction can you really have in some of these trends and some of the disruption trends when it might take a while to discover what it actually looks like?
Look, I think that's the number one question, both philosophically and also from an investment perspective, that we're all grappling with. What do you do when the idea of intelligence becomes a commodity? What does the democratization of intelligence actually mean for all of us? But from taking a step back from an investment perspective, every tech and disruption cycle ends up this way. You see a period of time where there's a lot of investment in building the infrastructure, which is what we've seen over the past couple of years. And then you're in this digestion period, which is where we are right now. Who are truly going to be the winners and who are going to be the folks who are left behind during this period of time? I think for us, it means a couple of things. One, it means that you need to be diversified from a exposure perspective, having exposure to the infrastructure players, which are primarily the hyperscalers and utility players within public markets, infrastructure, power infrastructure in private markets, and you want to start adding exposure to the application layer, but in a diversified way. Manager selection could not be any more important now than it has been over the past 5 years. So that barbell approach between infrastructure and application layer, and then outside of that, building durable and resilient portfolios. 50% of U.S. equity markets now are within tech. We're looking for geographic diversification, sector diversification, and to your point on real estate, just to bring it full circle, real estate is more than just office as well. Industrial real estate actually will end up benefiting from some of the investment that we're seeing on the power side and on the manufacturing side. So ensuring exposure not just to the areas that are going to win, but the areas that are more insulated, like core real assets, like even hedge funds in this period of time, where we're looking and trying to find less correlated, diversified return streams so that if something does end up going bump in the night, your portfolio will be resilient no matter what.
I could literally talk to you about this for hours. This has been so thoughtful. Thank you so much for joining. Really appreciate that. Sidara Sundar of JP Morgan Private Bank. Let's get a check on your equity markets. Nearly 40 minutes in your cash equity trade. We are still putting in losses this morning, down 1% for the NASDAQ 100. We've been down for 3 consecutive weeks with a equal weighted index just inches away from record highs, but it's a struggle of a day this morning as 10-year yields go a whole lot of nowhere. We're currently at 404 this morning. Brent crude, that starts to drop 1.4%. It had been rallying with the threat of Iran partially closing the Strait of Hormuz, but there does seem to be some progress in talks between Iran and the U.S. We're going to discuss that at the end of the hour, exactly where we are. Let's look at some of the single stocks that are on the move this morning. Warner Brothers has agreed to temporarily reopen negotiations with Paramount Skydance. It sets the stage for a potential second bidding war with Netflix. And now Netflix shares are losing. They're down 2%. Interesting, because Netflix usually have been gaining when there were hopes that maybe they wouldn't do this deal, because they'd also get a breakup fee. But anyway, shares are down. Paramount significantly up this morning. We're also watching shares of Norwegian Cruise after activist Elliott announced that it has built a more than 10% stake in the company. They're up 8%. And in other activist news, Starboard has delivered a letter to TripAdvisor urging a board overhaul, and the sale of the company, shares up 6.6%. Coming up, we're going to talk credit markets with David Manlow, CEO of Benefit Street Partners, a Franklin Templeton company that manages
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour only on Bloomberg Television.
To the minute
break global news whenever and wherever it happens. I'm Jemana Versace in Davos, Switzerland, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
When it matters, investors.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show. We've already talked this morning on your show. As you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible.
Bloomberg Surveillance. We're talking about it.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Bank of America's latest fund manager survey found that a record number of investors are concerned that companies are spending too much. Meanwhile, 30% of participants said that capital expenditures on AI by the big tech companies was most likely a source of a credit crisis. Joining us now to discuss is Dave Manlow, CEO of Benefit Street Partners, a Franklin Templeton company that manages $92 billion in assets. And of course, that comes from private credit. So you're the perfect person to ask about this, David. First of all, thank you so much for joining us this morning.
Thank you for having me. Really appreciate it.
And these big tech players are increasingly turning not just to public markets, but private markets too, to fund their infrastructure build out. Is this a real concern? Should it be a concern? Maybe that they're overspending and private credit players are getting more in the action?
Yeah, I actually think it's an opportunity. If you look at the Bank of America survey, there's been others out with the amount of debt capital that needs to be part of the financing stack for AI, that you are going to see a tremendous need for capital, and private capital and the liquid capital markets, credit markets, are going to be there to fill that gap. And whenever there's a gap, and it creates opportunity for excess spreads. And we do not believe that the spending that you're seeing is ill-fated from a return standpoint, that you are going to see returns from AI, and that is going to create a great opportunity for investments going forward. And then if you think about kind of the knock-on effects of that, is that's going to open up opportunities. And for example, where we lend into the core middle market. Mm-hmm. So if capital is migrating to these large data center deals, so on and so forth, you're going to see the opportunity to lend to the companies that are ultimately going to be applying the AI or being part of the build-out, which just, again, creates opportunity for private credit going forward.
There is this irony in the trade that's happening right now, because on one hand, people are saying, oh, there's a bubble. And then on the other hand, it's AI is so amazing and so great, it's going to disrupt things like software. Software and credit exposure has been a huge sticking point. How many of your LP calls have just been what's your software exposure and is everything okay?
Well, you've hit the nail on the head. It's like the starting point of every single call. And I kind of joke about it because it was the second half of last year where I did a number of panels. And the panels, every one of them were two subjects: AI and private credit, which I never thought as a debt person that we'd be in something so sexy as AI. But I think the reality is that the application of AI and the return that it's going to generate is all about opportunity. And then if you look at software, for example, I thought your prior guest was terrific in analyzing that.